trading let's say we're trading a stock here, and the stock is a price of $500. Okay, so we've got a $500 stock here, and somebody comes to me and they want to buy a call option. Okay, so the punter buys a call option. So what is my position? If the punter buys a call option, what is my position here? I'm going to be short calls, right? So obviously at 500, I am going to be short a call option. Am I long gamma or short gamma? I'm short gamma, right? So there's a problem here. So in that situation, at a price of 500, somebody comes along and wants to buy 100 shares, right? The option is for 100 shares, of course. It's a call option, and I've sold this. So if I want to hedge that properly, what do I have to do? If I want to hedge 100% of that position right now, what do I have to do? If I want to hedge that position, I absolutely need to buy 50 shares, right? I need to buy 50 shares, correct? So if we've got to buy 50 shares, that hedges what delta? That hedges a 50 delta position, correct? Everybody's happy with that. So obviously, for argument's sake, the price starts to rise. So if I buy 50 deltas, of course, that might put a bit of a bid into the market and the price starts to move up. So, and obviously we're moving towards an expiry as well. So let's assume we move up here and suddenly the price hits maybe 510. If we're moving towards expiry, what's just happened to that option delta? What would you say has happened to the option delta? If it was originally 0.5, what's the option delta now, perhaps? If it's originally 0.5, the option delta would probably be maybe if it's moving towards expiry, the option delta would be moving towards maybe 0.9, right? If it arrived at expiry, what would the option delta be? 1.0, right? So the option delta would hit 1.0 eventually, wouldn't it? So if it's arriving at 0.9, am I hedged? No, but I'm light 40 shares, correct? I am light 40 shares. Do you agree with that? Because I've got to hedge 90 delta. I've got to hedge 90 deltas, 90 shares. And obviously that happens over the course of the move. So obviously if the price starts rising and the delta goes from 50 to say 60 here, and then from 60 here to 70 here, and then from 70 here to 80 here, and from 80 to 90 here, I've probably bought 10 shares each time, haven't I? So on each of these rallies, I've maybe bought 10 more shares here, I've maybe bought 10 more shares here. And this is what we call slippy deltas, right? This is where we start seeing that slippy delta, slippy gamma story, because we are short gamma here. And eventually we get to this price, and now we've got plus 90 shares, and this is how this is now developing, right? So that's exactly right. So obviously as we come into this, this is something that you've got to pay attention to, because, that's going to bring in a buyer at higher prices. And if we know there's a buyer at higher prices, we should take advantage of that buyer at higher prices. And a lot of the times when you see an algorithm, for example, on the NASDAQ doing what those algorithms that we see on the NASDAQ doing, does that not maybe look a little bit like some delta hedging, perhaps? 5 contracts every tick higher, 5 more contracts. Could it be a possible delta hedger? Of course it could. So when you see those 5-lot buyers coming in, it could be a delta hedger coming in, which is why we always try and confirm the reason for the buying coming in isn't necessarily just delta hedging, in which case if it was delta hedging, we could start expecting to actually be able to fade those algorithmic buyers. Somebody buying every few ticks to hedge out 5 contracts on the NASDAQ would be reasonable. If you were an options algorithm, wouldn't it? Be reasonable if you were an options algorithm. So obviously this is something that you start recognizing as a possible truth. In other words, there could be a reason for the things that we're seeing versus simply not knowing what it is we're seeing. But this is why we sometimes see this. So if I was to draw you a NASDAQ chart, and all of a sudden the NASDAQ chart very much looked like this, where we saw this here, and then we saw this here, and then we saw this here, and we saw this here, and we saw this here, and I then says, well, every one of these is 5 contracts, would that look very similar in pattern? 5 contracts followed by 5 contracts, followed by 5 contracts, followed by 5 contracts, that kind of idea. Would that look very similar to the storyline we've just painted, for argument's sake, on the S&P here? Very similar, right? So this might be delta hedging. This might simply be delta hedgers coming in, obviously not defending a position, but delta hedgers coming in, pushing the price, because they need to. It's an algorithm. They need to push the price. It doesn't necessarily mean that this is always bullish, which is one of the things that we've tried to get you guys to understand, is that there's a lot of different drivers going on in the marketplace. And if you simplify it simply to say that's always a bullish algorithm, well, of course it's a bullish algorithm. They wouldn't have hedged it if they thought it was going to be selling, would they? They wouldn't have hedged it. So of course it's bullish, but how bullish is it in that situation? How bullish is it? Well, that's now down to you whether you have a bullish bias in the marketplace there. And if you've got that type of idea that there's a reason for this, that's when we start arriving at more of an informed trading assumption. So the guy that owns the short delta here, the short gamma here, the guy that owns that is aware that this is an informed buy and is wanting to hedge out their entire exposure on this. Needs to hedge out their entire exposure. So you imagine that in the desk here, you imagine that you've got a desk in front of you. And on your desk, you've got 2 big buttons. And every time somebody trades with you, we have a choice. The choice of these 2 buttons is hedge fully or take on your book, right? So take on your book. And if Pradeep was in the room, he'd give you a bit of an idea about this kind of concept here. So hedge fully or take on your book. Take on your book, right? So how do you make that decision? How would you make that decision as a trader, guys? How would you personally make that decision? So let's assume it was this scenario here. How would you make that decision? Well, of course, hedge fully means that as the delta improved, or as the price improved, obviously your delta position meant that you had to buy it. So obviously hedge fully meant that you had to do this trade, right? The algorithm would automatically now hedge out everything you've got on that hedge fully book. Now, if you're going to hedge fully, which group of traders would you put into this category here? Well, if you're in this category here, you would classify this as informed trading, right? Because why would you want to make sure you fully hedge it, unless, of course, that's just your business plan? But why would you want to maybe take something on your book? In other words, instead of taking that trade and hedging it, which is obviously taking away a big chunk of your profit, you might say, well, we're going to take it on the book because this is uninformed. This is uninformed trading, and therefore we're going to absorb any buying that this guy does. So we're going to buy and we're going to sell to their buying, and we're going to absorb their trading. And what you're going to see is that if anybody does hedge out that position, there's going to be sellers starting to come in against that. And the idea is that these guys haven't got a bloody clue. And we'll just take that risk on our books, which is what most prop trading desks do, is that they take, and Kim will tell you all about that, because that's their basic business model. Most of them, not all of them, I don't think, Kim, but that's the basic business model, is that they classify everybody that they take on as uninformed, right? So they classify everybody as uninformed. So therefore, whatever you do, they're willing to bet that you're going to get it wrong. That's pretty much their business plan, right? That's most prop desks' business plan. Whatever you do, they're willing to bet you're going to get it wrong. Yeah? Everybody know that? Did you not know that, Howard? That's interesting. If you do a quick search on it, this is what it comes up with. If you do a quick search, this is what it comes up with here. The B book. Have you heard of the B book? B book. So the B book, prop firms are trading firms that operate as the counterparty to the trader's own positions. So where a firm profits when the trader loses and vice versa, the model is standard for many retail CFD prop firms. The characteristics of a B book firm is that the firm takes the other side of your trades, not the market. Your trades never go to the market, ever, unless the counterparty hedges your trades, because they classify you as an informed trader. Interesting, isn't it? So if the counterparty classifies you as an informed trader and you put in a buy order, they will put in a buy order with the marketplace to hedge your outstanding positions. You understand that? So if you make money, they make money. If you lose money, they lose money. So, but most of the traders, 99% of the traders, the B-book companies will basically take the other side of your trade. And obviously when the B-book trader takes the other side of your trade, that means when you buy it, they're holding that position. It's not the market that's holding the position. Your trade never reaches the market. Never reaches the market. It never goes into the exchange. So that's just something to remember, guys.